Hello everyone and welcome back to the Accounting Desk. In today's lecture, we will discuss IFRS 16 leases. Leasing is a common way for businesses to use assets such as buildings, vehicles, and equipment without purchasing them. Before IFRS 16, many leases were kept off the balance sheet, which reduced transparency. IFRS 16 was introduced to ensure that most leases are recognized on the balance sheet, improving financial reporting. The objective of IFRS 16 is to establish principles for the recognition, measurement, presentation, and disclosure of leases. The standard ensures that lessees provide information that faithfully represents lease transactions. IMP ROVEs transparency and enhances comparability across companies. IFRS 16 applies to all leases except short-term leases of 12 months or less and leases of low-value assets. It also excludes certain arrangements such as licenses covered by IAS 38, intangible assets. A lease is a contract that conveys the right to control the use of an identified asset for a period of time. Key elements include an identified asset, right to control use, and economic benefits obtained by the lessee. IFRS 16 introduces a single accounting model for lessees. At the commencement date, the lessee recognizes a right to lease asset. The lessee also recognizes a lease liability, which represents the obligation to make lease payments. Lease liability equals the present value of future lease payments. Right of use asset equals the lease liability plus initial direct costs. Subsequent accounting, the raw asset is depreciated and the lease liability has interest expense recognized. This results in depreciation and interest expense. For lessors, IFRS 16 retains the classification finance lease, which transfers risks and rewards, or operating lease, which does not. Imagine a company leases equipment for 5 years with annual payments of $10,000. The total payments equal $50,000. Each year, interest expense is recognized, lease liability is reduced, and the asset is depreciated. This reflects economic reality. IFRS 16 significantly affects financial statements. Assets and liabilities increase, and EBITDA increases as rent expense is replaced. The standard requires disclosures like maturity analysis and nature of leasing activities to help users understand risks. Let's summarize today's lecture. IFRS 16 applies to lease contracts and requires recognizing right-of-use assets and lease liabilities. Understanding IFRS 16 is essential because leasing is widely used in modern business. Thank you for watching.